Good evening, everyone. Welcome to Your Money, Your Call. I'm Nina May. Great to have your company. Well, Roger and Elio, welcome to the show. Great to have you both on Your Money, Your Call.
Nice to be back, Nina.
Roger, I'm going to start with you.
Sure.
Market nudging near that 5,000 point mark. Is this what you expected 3 months into 2010, and where do you see things going from here?
Well, you know, my ability to predict where the stock market is going to go is about as good as a tadpole. So, you know, I don't know what the market's going to do. It looks like there, and we'll go through this tonight, I'm sure, as the calls come through, there are a lot of companies that seem to be expensive at the moment compared to their current value. So that would say in aggregate, the stock market seems to be a little bit expensive compared to its current value. Having said that, our economy is doing very well, and I think if the earnings and the revenue comes through, then we're going to see that the stocks are going to be about fair value, because I think I've said to you before when I've come on the program that it looks as though share prices are looking ahead 12 months to 2 years. So if those revenues and earnings surprise, then we're going to see that things look about right.
Mm-hmm. OK, so we could be going a bit more towards an equilibrium situation.
Yeah, and I should add, I'm not surprised that Telstra went down. I'm not surprised that Transurban went down, and we can talk about that during the program.
Yeah, I'm sure we will. Good evening, Mark.
Evening, panel. Wanted to know about Brambles. I've had 2 buys on it, for my dad at 485 and for myself at about 640, and we're just wondering, I thought $8 looked a bit of a level there, but wondering what the panel thought. OK, Brambles is stock code BXB and is currently sitting at $7.43. Your take on this one, Roger? We talked about it the last time I was on the program. You know, I think it's expensive compared to its intrinsic value. It's not a great business. It's not. It's an OK business. You know, it's not a wonderful business by any stretch of the imagination. I think I said to you when I was a kid living in Brunswick in Melbourne, you know, we used to rip apart pallets. Yeah. We used to rip apart the pallets and use them for BMX jumps. I think if you ask the company how do they keep track of all the pallets, they'd say with great difficulty. That's a difficult business to run. You know, it's just you don't need to be investing in difficult businesses. There are some really good ones out there. OK. Our next caller is one of our regulars, Abe from Sydney. Hi, Abe.
Oh, hi, Nina. Thank you for taking my call. My question is about NAB. At the current value, I mean, does the panel think that one should keep it, one should keep holding it, or should one sell it?
OK, NAB, of course, plenty going on with this bank at the moment, and it's currently trading at $27.37. Of course, we've got this whole issue, Roger, with AXA, etc.
Sure.
So what do you think? What's the answer to Abe's question there?
If out of the 4 banks, if there was one that I like the least, it'd be the NAB. I think the price they're paying for AXA is almost double what AXA is worth. And that's, of course, just one person's opinion, but I think they're going to pay a very high price, and shareholders who own the stock as a result of that purchase, you know, or following that purchase, may find that the stock underperforms. That's because they're going to pay such a high price that it's going to take some time for the return on equity of this company to follow through. The return on equity is going to go down as a result of the purchase, and it's going to take some time to recover. So during that period that return on equity is low, then you might see the share price stall.
Yeah, what do you reckon, Elio? Because of course we've got this March 29 deadline looming, and it appears that this is all going to happen. The 2 parties are optimistic that they're going to make an agreement. But do you agree with Roger's assessment that NAB's just paying too much?
Well, I definitely agree with Roger's statement in regards to it's the least favourite of the big 4 banks.
Whenever I hear the word synergy, I just want to crawl under a rock, you know, and I just think, no, thank you.
We hear it a lot on the business channel.
Well, yeah, it's the whole. Sorry about that. Oh, you better give me a rock. You know?
Yes.
But you know, it's that whole. You know, it's the whole frog kissing princess. You know, and hoping that the frog will turn into a prince. And it rarely does. You know, nothing gets the blood hotter than a takeover, and you know, being able to preside over something that, you know, that's going to be a lot bigger. But big is not always better. You know, and quite frankly, look, the NAB is losing market share compared to all of the other banks, you know, and this seems to be, you know, a desperate attempt to grow under the institutional imperative.
I don't want to harp on this too long because we do have other callers, but would an example of where, you know, a takeover in a sense and the synergies you have a more positive outlook towards. Would that be the whole Westpac St George?
That's probably the best one I've seen recently. Yeah, and another one that was reasonably good actually, but it was some time ago. They still paid a little bit too much, was the ASX and the SFE. When the ASX took over the Sydney Futures Exchange, it was obvious that there was going to be synergies there. There was clear duplication, and sure enough, in the first year of operating, you know, the synergies were greater, the benefits were greater than what they'd anticipated. But that's quite rare.
Okay, our next caller is Richard from Sydney. Thanks for waiting, Richard.
Evening, Glamour. A question for Roger and Elio. I bought some shares in Wilson's. I did my homework, bought them at the right price before a good financial report. The price rose. Then an agreement they had with Deutsche Bank was to be discontinued, and they had to pay out $14 million. The top man resigned, and a large amount of options became public knowledge. Naturally, the shares went down like a lead balloon. How are we mere mortals to make money when this sort of thing happens?
Okay, we're looking at stock code WIG here.
I actually think that the question isn't specifically related to Wilson's. I think it's a conceptual question about you know, if you're not privy to all the information and you're not perfectly informed, how can you make decisions? Look, there's no real solution to that other than I absolutely, and I've told everyone this, that you absolutely have to be able to value a business before you buy it. So you need to know what it's worth, and based on the information that's available, pay a discount to that price. So you need a big margin of safety. That's not going to get rid of the risk of losing money, but what it will do is it'll mitigate some of that risk. So make sure you know what these businesses are worth. I think that's the best answer I can give.
Is that I mean, that's all very good advice that Roger's giving as well, because it's very hard, isn't it, to give yourself that safety. You can give yourself a safety net, but you can never 100% protect yourself. All right, our next caller is David in the top end, Darwin. Hi, David.
Hello. Hi, panel.
G'day.
What's your question tonight?
My question tonight is what the panel, if they have any thoughts on Central Petroleum, code CTP. They're currently doing a capital raising. I bought them late last year for 7.7 cents, and the capital raising is 7.5, and whether I should buy some more shares. Thank you.
All right, currently trading about the 8-9 cent mark. It's CTP, as David pointed out, is the stock code.
Are they producing? They're not producing yet?
No.
No. Okay. So your issue is how much cash they've got on the balance sheet and what their cash burn rate is.
Yes.
As long as they don't find anything worthy of producing, that cash that sits in the bank is all they've got between being a listed company and a prospect and oblivion. So what you want to check is, how long does that cash that they raise last? How quickly do they burn it on a monthly basis? Because you know that when they run out of that cash, they have to raise some more, and you'll continue to be diluted if you don't participate in those raisings. So look, my advice to you would be, have a look at how much cash is on the balance sheet, how much they're raising, what their cash burn rate is, and that'll give you an idea of how long it's going to be till the next capital raising.